Aloha, ladies and gentlemen. Happy Thursday, July 31st, 5:12 p.m. Hawaiian Standard Time. The days of me recording videos and trading stocks and options in the Hawaiian Standard Time zone are rapidly coming to an end. The expiration date on my 25-year Hawaiian vacation is August 22nd, assuming everything goes according to plan. But today, this video is not talking about the expiration date of my 25-year Hawaiian vacation. Today's video is talking about my favorite stocks to sell options on in 2025. So let's get into it. First one, I'm going to tell you that I have thoroughly been enjoying selling options on is ServiceNow, ticker symbol NOW. Now, if you don't know what these stocks are, go ahead and look them up. Look over the fundamentals, the summary, a lot of data. And also, I really need to let you know is that just because I've been enjoying selling options on these stocks doesn't mean you will enjoy selling options on these stocks. Definitely, ServiceNow is not for the faint of heart. Even though it has a beta of less than one, which is basically for every dollar move of the SPX, this stock will move a little bit less. But even though it does that, I tell you what, it can really make some wild swings. And while I'm showing you these different stocks, most of them I will have positions on, so I'm going to keep those positions in secret mode here. Obviously, I can't keep it too secret. I've got one that expiring on August 8th, but exactly the details of that, I'm going to keep that closed. And for this particular one, I will tell you though that I'm usually selling like a week or less, and I get it. 8 days is I opened this position today. I closed a position that I opened last week or at the beginning of this week. I can't remember exactly when I opened it, but I closed one today and I opened another one for next week. So the one that I closed expires here. Opened up another one. And let's take a look at the 15 days. The reason why I've been enjoying selling options on ServiceNow is I think mainly because it's an expensive stock, so it has basically expensive option premium. For example, what I always do is I tend to gravitate towards the 5 delta. Right here, we got a 6 delta and a 4 delta. So we're going to look at these two as a reference. And I like to look and see how much option premium can I get for like around a 5 delta. And the reason why I'm choosing a 5 delta is because for several years I've been putting together a plan for me to be trading for a living. And I did it under the rich dad cash flow game model where step one is get out of the rat race. So when I was putting together strategies to get myself out of the rat race, I'm not looking to get rich while I'm not looking I'm not looking for get rich strategies. That doesn't mean I haven't been working on get rich strategies. If you look at trading crude oil, it's highly levered and you can definitely make a lot of money in a short amount of time. But that's not what these particular trades are for. These particular trades are to make sure my monthly bills are paid so I can exit the rat race and focus on making a lot more money with high 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 mentally trades that require a lot of mental thinking, right? So anyways, so around the 5 delta, you've got about a 95% chance of it expiring worthless. And look at you, and here the highest it sold for on this 820 was around $1.70. This one $1.75. But right now, or towards the end of the day, you could have got closer to $2 for this option. And the reason why I have really sometimes I'm okay with like getting closer to like 10 or $20, $15, these lower numbers. But on this particular stock, what I found is if I can get filled for like getting closer to 150 or higher, then after about 3 to 4 days, a good amount of theta decay has set in. And even if the stock starts moving against me, closer towards the expiration date, I can usually close out the position for around $100 profit, right around $100 profit. For example, the one I closed out today, I was originally filled for 130, and I closed it out today for 25 cents. So made a little bit over $100 in like around a week on that particular uh, on that particular stock. So this is one that I like. And if I haven't pointed this out already, the Thinkorswim algorithm, or I don't know if it's an algorithm or what it is, this implied volatility is pricing in about a plus or minus move of about $50 and almost 60 cents. So you can take 943 and 12 cents minus this number here and make sure you're picking a strike price that's lower than this number minus this number, giving yourself a higher probability of uh, making a profitable trade. I'm trying to get away from using the terms winning and losing or a successful trade. And the reason why, one of Noah Davidson from the Cash Flow Academy was talking about income and expense is more along a business way of thinking, where winning and losing is more about like a gambling mindset. And I am definitely attempting to run this option trading as a business. Another way we can look at some probabilities here is over on this. So this is one standard deviation. This is a little more than one standard deviation. And you can see over here we got the dates, and over here we have numbers. So as we go, let's look at the 8th. So on the bottom we see we're on August 8th, which is the next expiration date. Was that the expiration? That's the expiration date that I have a position on, or August 15th or whatever. And so I'd be looking to sell an option. Can I sell lower? Can I sell something around the 850, somewhere around 850, below 860 to 850? And let's see what's there. 860, we're at a 9 delta. Look at that. We can get all the way down here to like that 4 or 5 and be down here around the 4. So just another way of making sure that these statistical probabilities are on our side. And then, so let's look at the next stock. What is another stock? Because overall, I don't really want to show you in this video how exactly I'm trading them, even though I'm doing it a little bit. But let me show you some different stocks and why. Another one that I've been consistently trading all year, as you see, I have a position on that will expire on August 8th, is Tesla. Tesla implied volatility around 54. Let's look at it now. We didn't look at that one, just so we can compare. Okay, 32, pretty low. Pretty low. Tesla's looking better though. I guess just because it's a high price stock, it's working out. So let's look at the same 15 days. And let's look around that 5 delta. Okay, around the 5 delta, look at that. Around 80 bucks. What's the highest it traded for today? So you could got today you could have got filled at around 90, 100 bucks, somewhere in there, for a trade that has a pretty high percent chance of expiring worthless and just being total profit. This one has this one has a lot of volume. A lot of people trade this particular stock and the options on the stock, so the liquidity is way better. Fills are way better. With ServiceNow, there's not nearly as much volume. So I think what I found is that I really have to be picky about getting a good fill price, because it's not going to be easy for me to exit it. Some of these stocks are so liquid that I'm not as worried about getting a bad fill price on the entry, just because if the stock drops a little bit and I need to get out for some reason, kind of like a emergency get out, there's enough liquidity to get out. But with ServiceNow, that's not really like that. So I'm getting the best fill price I can possibly get, and then letting theta decay kick in. And then normally, even if the stock is moving against me, if I got a really good fill price and the theta decay is kicked in, I'm able to exit out profitably if I need to before expiration. Now, of course, all the time I want to get the best fill price, but it seems like the less liquid stocks, it's even more important. So Tesla is another one that I have been consistently trading. And what I've been doing on this one is I'm trying to stay around the 200 strike price, which we're already in the one delta. But look at this. This is one thing that's really amazing about Tesla is that we're down here into like two delta, one delta, and you can still get paid. You might not be getting paid a lot, but maybe you can put on more than one contract depending on how much buying power you have. Another thing to consider is that is this your get rich strategy or is this your pay your bills strategy? Now, for me, it's my pay my bills strategy. So I'm not as concerned with making as much money as possible. I'm concerned with how can I consistently and reliably pay bills month after month after month and do it in advance. Like for example, all my bills for August really need to be paid for by trades I did in July. So having the same stocks that I can reliably, consistently, and have a high ability to predict the outcome is super helpful instead of scrambling all over the place. Another one that has been lovely to me is the Spy on You company. As you see, I got a position on here that's expiring tomorrow. Let's look at the 8 days. Computer is pricing in around a little bit less than a $20 move. So you take this number minus 20, find a strike price that's below that. Again, I like to look at I like to make sure that strike price is above the 5 delta. And I still, a lot of times, go to that 5 delta. So again, further away from the money, the lower the buying power is going to be, making it easier to put on more contracts on the same stock or spreading that more contracts out through other stocks. But around, let's see, if you were to timed it better, you could get around $80 for around 5 delta. It's pretty good for 8 days. Another stock that I've been enjoying, NVDA. Is that what it is? Yep, it sure is. This one, another position that's going to be expiring tomorrow. Where let's look at that. Another one. Look here in the one delta, two delta. I get it. It's not a whole lot of money, but it's just the fact that around this 5 delta, around $27, pricing in about an $8.50 move up or down. It's just really been consistent cash register, cha-ching, 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 cha-ching. Week after week, these stocks have been really good for me. With the one that needs the most maintenance is ServiceNow. That one has really been the biggest stinker out of these. So, but I have been profitably managing everything. What is another one? Oh, that's right, GLD. This one has been good too. Now, all the other stocks that I've talked about up until this one have been actual companies. So you want to be mindful of when the companies' earnings are reported. And I personally will set up my trades so the options will expire right before earnings, or I just wait till earnings are done. Because I've got a handful of stocks, and these are the ones that I've been doing the most. But there's other ones like ExxonMobil and MO and Apple and Microsoft and CrowdStrike. There's a variety of other ones that I'll look at. So I feel like I have enough that I don't really need to trade during earnings. I can just kind of try to strategically do it. But this particular stock, this ETF, it doesn't have earnings. So that's something you wouldn't have to worry about. And overall, gold, this is a 20-day moving average. And look from left to right, it's been going up on this weekly chart over the last year. So overall, gold, for the last about 14 weeks or so, it's basically been moving sideways. But when you're selling put options down here and it's moving sideways, it's not going down, then that theta decay just keeps kicking in. Now it went down a little bit here, so you need to be mindful of how much time are you selling and what strike price are you selling at. So for example, if you're selling 45 days, when it starts dropping down, and if you have 30 days left to expiration, that's a lot different than when you have 2 days left to expiration and your strike price is at 280 or 285 or something, and it's dropping down like this. So these are things that you want to factor in there. And there's other ones, as I mentioned, there's other ones I've been selling options on. Obviously, I got a position here that's going to be expiring. The last thing I'll leave you with is you may notice that I, by default, sell put options. And I just feel a lot more comfortable with them because for two reasons. One, the first thing is the idea of a cash secured put option. The second thing is if you sell a put option and you don't have the full amount of cash to cover the commitment, but you do have enough margin to cover the commitment, then if you structure things properly, that can be used to your advantage. Now, the key couple of words that I said in that is if you structure things properly. If you do not know how to structure things properly, then don't be selling put options that you think you're going to take ownership of the stock in with your margin money. Don't do that if you don't know what I mean, or not if you don't have your own meaning and effectiveness with structure things properly. I do, so I feel safe with doing it. But what I also do is also sell um, I will also sell strangles. Yep, I will strangle stocks. Now you notice I have two positions here. It's because I've got a strangle set up. And maybe some technical name mumble jumble people are going to be like, well, it's technically not a strangle because it's a calendar spread because you have different expiration dates. Okay, whatever name you want to put on it, I don't really give a rip. I don't care. What I care about is, can I pay my electric bill? Can I pay my gas? Can I buy food when I want to buy food? And do I have enough money left over to pay tax? I don't really care about the names. I care about the effectiveness of the income. And so I started with a position here. So X amount of time ago. Maybe I sold it closer to 30 days. I can't quite remember, but I'm short um, on the put side over here. And then I added a call over here that's of shorter duration. And why is that? Why did I do it that way? Well, because I feel like there's more danger to the upside, especially if Bitcoin drops quite a bit, then this ETF is going to go down. And that's all good because I think at some point Bitcoin will go up. So I don't mind taking possession of X amount of shares at some undisclosed strike price down here in these numbers. But what if it goes up? If it goes up, the only way I can really cover myself effectively is to buy 100 shares before it hits my strike price. Or I could also buy a put option, or excuse me, I could buy a call option to cover that. But from learning from Noah Davison from the Cash Flow Academy, hedging with stock is just the best way. And I found through selling strangles with the put options being cash secured, I also like cash secured on the call side too. So if I want to minimize that risk of needing to buy stock in order to to turn the naked call into a covered call, if I do not want to have that risk as large, I will sell for shorter duration and I will open and close a lot faster. So, for example, there have been a couple times when I had, let's say, a put option that had less than 9 days to close. Let's say 8 days, maybe even 5 days, and I might open and close a short call somewhere between 1 to 4 times during the time when I had one put option. Open, close, open, close. So I'm not trying to make as much money. I'm just really trying to squeeze out some profit, squeeze out some profit, take off risk, take off risk, take off risk, and putting money in my pocket, putting money in my pocket, putting money in my pocket. And these are stocks that I have been doing that with. Another one that I've been doing it with, but not as often, has been CrowdStrike. So I'm not as familiar with that. A little bit bigger implied volatility here. But when I'm not finding anything exciting on ServiceNow, I've been looking at CrowdStrike because it's a high price stock as well. But that's it for this video, ladies and gentlemen. If you've been watching, or if you watch any of these videos that I made in the last, just recently in like the last month or so, it's a lot of just this option selling based on probabilities around a 5 delta, looking for low hanging fruit. Not the very first option trading class I went to, but when I really decided I want to get good at this, I went to this one called Invest Tools. And sometimes when I make these videos, sometimes people remember that Invest Tools. That was around 2009. And I remember one of the courses I went to from Invest Tools, they talked about this idea of you're structuring, you have like 100% of your money, and then the bulk of your money, whether that's going to be 60% or 70% or something like that, the bulk of your money, you're looking for base hits. Base hits. If you get a double once in a while, that's good. But then so let's say you have roughly about 60% of your money doing that. And then you have another like 20% that's doing, maybe you're going for doubles and triples. And then with that, then you're at what, 80%? Then you have 10% that you're going for home runs, and then you have 10% that's just sitting in cash. And that, playing these probabilities like that, if you're striking out while you're going for these home runs, which is, having an expense versus um, a profit, then you're not getting wiped out because you're constantly growing your account with these singles, these doubles that aren't really exciting, but by being the tortoise, you're really winning the race. And that has never left my mind. It's always stuck with my mind, and it's been really important for me to become highly proficient at something like that, because as I played the cash flow game online more, which I first started playing it on the board game, but once it went online, there was no point in taking out my board game anymore and clearing off a bunch of space on my desk. But as I played that more and more, and really started um, looking at that game and looking at my own financial statement, and start lowering my monthly expenses and really fine tuning my own financial statement, it just became more and more important to me to have some bread and butter, or at least one bread and butter strategy, which I feel like I have at least two bread and butter strategies, but one or two bread and butter strategies that I can really rely on consistently with a high degree of probability and predictability to be able to pay my monthly bills. Two, which where I'm at right now is exiting the rat race and being a full time trader. By the end of August, knock on wood, I will be living in the Eastern Standard Time Zone and making all of this trading much easier, being in same time zone, and being able to get a good night's sleep and waking up, watching the market, and living on a 10-acre lot with hardly anything to do, hardly any people around, very, very rural area, and the ability to just talk to the birds, communicate with the squirrels, and ask them for advice on how I should go forward in setting up some home run trades. You guys have a fantastic day.